Good morning, everyone. Bill Fung here with Your Castle Real Estate, your local Denver realtor, serving the southeast area. Today I'm at my company's quarterly meeting, and I'll be going ahead and recording some of the information for you about what's happening in the market. There'll be a number of people talking, and one of the people talking is our CEO, Lon Welch. So enjoy this. We'll talk a little later. Bye.
So here's the price appreciation. You can see that it's slowed down a little bit for the houses, which is the land at the top, going down a little bit for the condos. This chart just shows you the amount of active inventory. So this chart, I think, is really useful for buyers and sellers for level setting to express where the market's at right now, what might happen next, and how to feel about it. So the important context here is if you rewind back to 2007, which is the left-hand side of this chart, amazingly, we had a moment where we had over 35,000 active listings. So right now we're, 13, 14,000. It feels like a lot because in relative history, this is a lot. But historically, you had a whole period of time there where it was a whole lot higher than that. So it's not a time to panic. It's just a time to be smart about pricing, and it's time to work hard, but it's definitely not a time to panic. The good news is, lots of agents are panicking, and if you're the only clear-headed person who's talking to your database, making your calls consistently, you should be able to take market share from the people who are not. Does that make sense? Mm-hmm. It's a huge opportunity for us who just want to do the work, which is basically Amy's whole theme that we're calling. Active inventory this year, the purple line at the top is where we're trending so far, so you can see that it's quite a bit above the last few. The line here that I think really matters is this one that says 19. That's pre-COVID, so we finally have gotten above the pre-COVID numbers in a sustained sort of way. Actually, for a buyer, it's not a bad time. There's a decent amount of inventory to look at it, so you can actually have a shot at negotiating the terms that you want. Showings per active listing is down this year, but not by a lot. I'm actually shocked that it isn't worse than this, because the number of listings has increased a lot. So are you guys showing more homes to buyers? Are most of you? Okay, that's what it is then, because the number of buyers is the same or a little less, but our inventory's gone up a bunch. So I really thought that the showings per listing would have been down because the pie's getting cut into so many little bitty slices. So you guys are just doing a lot more showing traffic. Okay, that's what's driving this. Makes sense. Month of inventory, so you can see where we're at right now. A little under 4 months. So last time we saw that was 10, 12 years ago, something like that. Okay, this chart just takes the overall market and we divide it up into sizes of homes. These are just houses, there's no condos in this one. So the top of the chart is the smallest 10% of the homes. We're not looking at basements, so it's like 1,000 feet in the bottom, or below, I'm sorry. The bottom of the chart are the biggest homes, the biggest 10%, so it's like 2,900 feet and larger. And then you've got a couple sizes in between. The second column over is the number of sold listings by size. So that's designed to be a bell curve. We force it to be that way. And you can see that the days on market is the fastest for the smaller homes, it's longest for the big homes. That's very typical. The ratios are very typical. All of this is very typical of what you'd expect with this degree of inventory in the market. There's nothing strange about this. I went back, because I've been doing this for over 20 years now. The last couple of times we've had this much inventory in the market, how long did it take to sell stuff? It's very, very similar to what we have right now. It's very much just business as usual. So I want all of you to kind of adopt that mindset that there's nothing bad about this market. It's just a little bit different. We just have to use a slightly different playbook and we can be successful in this market. Inventory is higher for big homes than small homes, no surprise there. Price change in the last year is relatively consistent across all of them. There's no real big story there. On the condo side, the inventory build, this is average. It's very big for the smallest ones. Usually, you'd expect this to look like the houses, where the biggest houses have the most months of inventory and the smallest have the least. Historically, it always looks that way. Not here, it's the exact opposite. I've not ever seen that before. What this looks like to me is a complete abdication of first-time buyers and investors to buy small condos. Is that what it feels like? Does anybody have a listing or thought about having a listing on the small condo side? I have 4 of them I'd like to sell, and I'm just not going to do it because this is just a bloodbath of a market. I just don't want to be part of it. Terrible time. But the rest of the condo market is doing better. Price changes at the moment, it looks like we're doing relatively consistently across all these with the exception of the smallest condos, and they're off by 9%. At some point, and that point probably is now, does anybody have investors for a small condo product? 3 people out of 200. There's an illustration of our problem. I imagine you can go out there and negotiate an incredibly good price. The HOA, or the 4 small condos I have that I'd like to sell, there's like 7 active listings. And there was a guy that started at 150, which is too high. He got down to like 130, which is the right price point. And he just kept cutting at 10,000 every 2 weeks. Last time I looked, it was 90,000. It still hasn't sold yet. At some point, that's going to be worth it to somebody. You may have a buyer who should go buy that. I was thinking about buying it myself. I hate this community. I hate these condos, but shit, I think I'm gonna buy it. All right, days on market is up a little bit, but not catastrophically. This might be a good thing to show to your listing. It is taking more time to sell a house, but it's not catastrophically longer. It's just a little bit longer. It'll also help you to sell expectations, like Eric was referencing when you're talking to the client. I'm not going to have it sold the first 2 weeks. It's going to take a little longer, and that's okay. All right. Anything on Denver trends you guys want to cover? Yeah.
If you had to concisely describe why the market is slowing as rapidly as it is, what would you say about that?
It's all consumer confidence driven, which is my next couple slides. So I'll give you the 20 bucks for leaving the witness. Excellent. Others? Yes? God, I wish we would, but I don't see any path to that, regrettably. I wish I had a good answer for you. Well, if I'm only going to dispense bad news, no one's going to ask any questions. That's a buzzkill. All right, consumers that drive where the mortgage rates are at now. I built a couple slides to illustrate this, because I haven't done this in a while. So the first thing is the 10-year treasury, which is on the upper part here. You can see that we're floating around. Well, I'm sorry, the upper chart is the 30-year fixed rate mortgage, so we're like at, what, 6.9? Where are my lenders at? 6.9? And that's about where we were back, say, in 2005 or 2002. So where do you get the pricing from? It comes from 2 things. There is I'm going to come back to that, the 10-year treasury. So the U.S. federal government is running a deficit. The way that we pay for the deficit is we sell treasuries. The most popular one is a 10-year. They sell 5s and 30s and a couple other durations. But the 10-year treasury is the gold standard of how people raise debt in the government to pay for the deficit. Are the deficits going up or down? By a little or a lot? So we've got a problem. It's a supply-demand problem that we have a lot of debt that we've got to put into the marketplace, and we have to attract investors from around the globe to come buy all of our debt to fund our deficits. How do we attract more investors? We raise the rates. So what you're going to see as a result of the tax bill that passed, there's good things and bad things about this tax bill, but one thing that you really can't deny is that there's going to be just a lot more deficit spending. We have to move a lot more of these 10-year treasuries, and the market price on interest will have to go up to attract a couple $1 trillion to fund it all. Does that make sense? So that's the first thing. The second thing, that's easy to understand, I think, right? Nothing mysterious about supply and demand. So the second thing is there's a risk premium. So the difference between the mortgage rate, let's say that's, what, 6.9 you said? And the 10 years, what, 4.4? So it's like a 2.5% delta between the two. That's the risk premium. Because giving you a mortgage is more risky than me getting debt from the government, because the debt from the government is guaranteed by the government. They're going to pay it back. There's no risk about that. So if you take a look at the risk premium over time, you can see that we're at a very high level right now, historically speaking. Why is that? So the easiest way to explain this is that when, you remember like in April of 2020, and COVID was the #1 headline and we were all in a complete panic? And we had like a 6-week period where we were just not even allowed to show houses because we were all locked up in our houses. So it led to like almost a financial panic. So what the Fed did to stabilize the economy is they flooded the economy with lots and lots of dollars. And that provided the liquidity so we didn't have a financial crisis during COVID. It was definitely the right thing to do. One of the ways they pumped a lot of money into the economy was they started buying mortgage-backed securities. So the way to think about mortgage-backed securities, like if 100 of you guys sell a house and they've all got a mortgage, I can take those 100 mortgages and I can rubber band them together and I can slice them up, and those slices are called MBS, mortgage-backed securities. And then I can go to Wall Street and I can sell the mortgage-backed securities off. So Joe's company originates 100 loans, he packages them up, they keep a few on their balance sheet, the rest they sell. All the money comes back to Joe's mortgage brokerage, and then he can make 100 more loans for you guys to sell 100 more houses. Does that make sense? This is how the mortgage system works. What the Fed did during COVID to stabilize things is they bought, it was like right around 3 trillion, not billion, trillion. They bought $3 trillion worth of mortgage-backed securities. It was an incredible, unprecedented amount of liquidity. What happened to mortgage rates? They went from like 6 to like 2.5. You guys remember that? And it was like that. It was like over the course of like 3 months. Unbelievable. So the only reason why we had these ultra low interest rates is because the Federal Reserve bought $3 trillion of them, and they didn't care what the price was. If the mortgage rate, come up, okay. If the mortgage rate was at 2.5%, and most normal investors would say that's too low of a rate, I don't like the risk, you can keep it, I don't want it. Fed bought it anyway. Where do you think all those MBS are still at? They're still at the Fed. There's $2 trillion on their balance sheet. They've got to get rid of them. So the investors in the mortgage-backed security market, would they, if your mortgage for $100,000, would I pay $100,000 to buy his mortgage if it's at 2.5% when the rate today is 6.9? No, there's a finance formula you could use from your finance class to figure out it's probably like $71,000 or something like that. So I, as an investor today, if I am going to buy an MBS from the Fed that are all ultra cheap loans, I'm going to pay a really big discount, right? How excited is the Fed about selling these things off at a big discount, recognizing a like hundreds of billion-dollar loss? You've got a guy who's in trouble for being over his budget doing a renovation in Washington. You can just imagine like the headlines that would generate, right? So as long as the Fed holds all these, this risk premium cannot go down. So you keep hearing from these pundits saying, well, mortgage rates are going to go down by the end of the year. Like, show me science behind that. Because I've looked at this a bunch of different ways. I cannot figure out how to do it. It's not going to happen. So I'm out of time, so I should probably wrap up. Do we have like 1 or 2 urgent questions I should answer, or should we move on? All right, thank you guys.